start off the show each week with just a summary of what I saw happening in the stock market. I do, of course, a Monday through Thursday summary of what I happened for that day, kind of things I think had the biggest impact. And then Fridays I try to do for the whole week. And so let's start off with that. Okay, so we've got our traditional chart here going back to 2018. And you can see here it's going okay still, right?
Yep.
I mean, yesterday we hit an all-time high. The S&P 500 broke through 6,500, which I think is fairly significant, actually. We continue to recover from that, April drop that we had after Liberation Day. Um, Ironically, the tariffs are almost exactly back to where they were, just a little bit shy of that tariff time frame. And so we'll talk about kind of, why is the market up so much in the face of so many different things? I mean, because a lot of times I think to myself, things could go okay, but then they keep stacking things against the stock market, at least from a traditional sense, and the things that I'm used to looking at as far as that goes. So, because I think that there's some danger here, and it's the reason that we have one third of our normal stock market allocation out of the stock market and in T-bills is because, when I look at the teeter-totter of what could drive the market forward and what could drive the market down, I'm still obviously up on the side of driving it forward. That's why we still have two-thirds of the market in. So the things I look at that I think are positive for the stock market, first of all, the fact that it's hitting new highs, it's moving in the right direction, the momentum is upward, right? And so, primary direction is up. All the different measures that I would use for 200-day moving average, higher highs, lower and higher lows, all those different types of things. Primary direction is definitely up. And then you've got this artificial intelligence trade, which is, a huge capital expenditure, especially by some of these really big companies. That's definitely exciting the market. Uh,
Mhm.
a lot like what we saw in 2000, although in some ways so far this is better than what we saw in 2000 because these are companies making serious money, right?
Yeah, like NVIDIA, it's not like they have nothing coming producing. They're
That's
doing
right. And we started out that way a little bit, like in the 2000, we had Cisco, for example, and they were making, really good money. They weren't a big company at the time, per se, kind of like NVIDIA is, or even an older company like NVIDIA is. But we still had some of that, but it eventually became a situation where these companies had no earnings. A lot of them didn't have a product. I still think if we didn't have so many other things on the negative side to drag the market down, we'd still see that here in short order. Over the next 2 years, we'd see this kind of craziness with IPOs coming out from AI companies, whether they had a real product or earnings or what have you or not. I still think that's kind of the same type of euphoria that we saw back then. So, but at the moment, I think that's a very positive driver to the upside. You've got some deregulation coming through, especially with some of the banks. The market likes that. We had that big, beautiful bill with a tax basically cut ish. I mean, they kept the tax brackets more or less where they were. There were some other cuts that happened there too. But again, that's the market sees that as stimulative. The bond market might struggle with that a little bit. So we'll see what happens just because the bond market's going to have this kind of $3-4 trillion projected deficit to deal with that they've got to issue new bonds for. So, um, but nonetheless, you take those components, direction of the market, the AI trade, and really deregulation, and all of these different pieces, and you've got a market that could be moving up. Okay, but on the other side, we have this situation where we have these tariffs, right? And they're starting to hit. We'll talk about that here in a minute. Starting to hit earnings. We're getting earnings reports now. So I said August, September, October is when we start to see more and more of the impact of tariffs. And that's definitely true. And I think it'll continue to build in terms of what we see throughout those months and beyond, depending on what happens. And so that's a huge deal. We did not have tariffs in the 95 to 2000 run up, right?
Mhm.
Best 5 years in history stock market. Similar scenario because everybody's excited about the internet and the dot com, revolution to what we have now with artificial intelligence, but we didn't have tariffs then, right? We didn't have this level of deportation where um, No matter how many people they're deporting, the way that it's happening is scaring the workers, and a lot of them aren't showing up to work. They're avoiding certain areas completely, and you're hearing a tremendous number of stories from the agriculture, construction, meat packing, businesses where they're, running into problems with getting labor, and that's going to affect the pricing. Either you're going to have less supply of those, or if you do have the same supply, probably those companies have to pay more for the labor to get that to the store, which probably means price increases. We saw, for example, raw vegetables jump up 38.9% year over year last month. Those are the types of things I think that deportations bring. Again, in that 2000 run up, that we had, it was so exciting. We didn't have this type of deportation where you had people not showing up to work. Okay, so I think that's different. And then the last thing that I think is really on the other side of the teeter-totter here has to do with the fact that, you've got a scenario where we're impinging the freedom of the Fed, the independence of the Fed. We've been calling the Fed Reserve Chairman names,
Mhm.
literally, for quite some time now, and now we're trying to fire, or we have fired, it's depending on what the courts, I guess, end up saying as to whether you can do this or not. One of the Fed governors, she apparently put down that she had a primary residence in 2 different places, so, you get a favorable, rate on your mortgage, if it's a primary residence. So, there's a lot of debate about what that means and how that's going to work, but it doesn't really have anything to do with her mortgage issues. It has to do with trying to assert control over the Federal Reserve. And that's a really, really scary thing to the stock market as a whole, as far as that goes. So again, we didn't have that in the 95 to 2000 run up either. So that's, I think, we're seeing new all-time highs, and the market is doing okay, in my opinion. And it seems like the dip buyers are still there. Last Friday the market dropped, and the market came right back after that, right?
Mhm.
And markets, are responding to these different things. So I think, lastly, I'd put on the negative side is this concept that, the US produces a lot of numbers that are really important for us to be, know to be able to do our work and analyze what's happening in the economy and the stock market. And when you start to fire the people that come up with numbers that you don't like, that's another thing that the market's going to struggle with. And we'll talk about some ways to get around that. But it's a really interesting area. And one of the numbers that came out today was the, PCE price index. Okay, so PCE is personal consumption expenditure. It's the price index. This is the favored measure for the Federal Reserve. This is the core PCE, which means they reduce, take out energy and food. And you can see it's going up, right? It's on a trend here going back from May. It's gone up every single month. It's up to 2.9%. The Fed target is 2%,
Yeah.
right? Now, if you look at this is the last 12 months. It's kind of volatile. I mean, look at back in February before the tariffs came, it was actually slightly higher.
Mhm.
So yeah, we'll see how this plays out. But I think a couple things here. Can we trust the number? Right? And now I'm having to ask myself that. I never had to ask myself that before. Can we trust the number? We're having to take loyalty tests and all these different departments and such. And there's supposed to be this kind of checks and balances and separation for some of these things. They seem to be blurring. But let's say we can trust the number. What we aren't seeing, if that's true, if this numbers are accurate, we're not seeing a big push through from the companies, right,
Mhm.
into the consumer price. And so I saw one study that said it was something, the low, like 14, 15% was being paid by the exporter. Okay, 60 some odd percent was being paid by the company, and 20 some odd percent was being paid. I don't remember the exact numbers, but you get the idea. It was being paid by the consumer. But the report and the study, said that within 6 months, the consumer would be at about 67% of those increases. So
Yeah, because the shareholders aren't gonna be happy with the company if they keep eating the costs.
yeah, and that's the problem right there. So if you keep eating the cost at that kind of 60+% level, first of all, some places you can't do it. I read this one article, this lady saying, "Well, I can't sell things, for $2. It cost me $5." So she had a store that sold cards, small business, and they get a lot of their cards from Europe and Japan and what have you. and she says that we're going to have to raise our prices. I mean, like you say, we can't stay in business, doing that. Some of these bigger firms can absorb some of those losses, but even then, first of all, they probably won't, just because that's not what they do. Secondly, there is the obligation to the shareholder, right? So they can't just eat that stuff, and so eventually it's going to come through. You'll probably see it in these charts. I wouldn't be surprised to see a 3 or 4%, year over year jump, in this particular chart by the end of the year, based on what tariffs are doing. And so that makes it difficult for the Federal Reserve. Uh, okay, so I want to put one backdrop on this before I kind of discuss two other issues. First of all, one of the things that we're seeing over and over, I'm getting a lot of information. This is one of the most expensive markets in the history of the stock market. And so just in and of itself, that's not the end of the world. We saw in 2000 where, the 95 to 2000 run where it just got more and more expensive, more and more expensive. And it could go up 40, 50% from here, because at some point in time, valuations sort of disappear.
Mhm.
And then all of a sudden they kind of come back. And that's usually when you get those big downturns. Like we did, we had a 48% downturn in the 2000, because it just kept going and going and the valuations got to be really ridiculous. But on many measures right now, we're actually higher in valuation than we were at the peak in 2000. So this is one measure here. Now we're actually not higher here. We're second highest, going back to, maybe take that Chiron away. So there we go, going back to 1880. And so what this is called the Shiller PE ratio. This is Robert Shiller. He's a professor at Yale. This is very well thought of. They take an average of the 10-year earnings and all the companies on the S&P 500, and they factor out inflation. We're currently at 39.18 right now, second highest in history, only after the dot-com bubble.
Yeah.
Historically, when you get over 30, and it's only happened 5 times, the market drops an average of 30%. Okay, so again, could go higher, but we're pretty highly priced here. Okay, so we're priced for perfection, and things aren't perfect. I guess that's
Yeah.
one of my concerns. So here's another measure. This is price to book. Okay, so the book value of a company is, you basically take the number of shares, and you compare it to uh, uh, the actual value of holdings. What are my machines worth? One of those type of things. And again, it's a weird measure, actually. It's not really well thought of, but on that basis, we are the highest, most expensive market in history at 5.3 times book value of companies. Okay. And so here's another one. This is really popular, very, very popular. This is a Buffett indicator. And this is something that, Warren Buffett came up with years and years ago. And that's just, if you take a look at the value of um, you know, the total value of the stock market versus the total amount of gross domestic product that the country is producing. And right now we're at 217%. So in other words, the market is worth 217% more than the gross domestic product. The average is actually closer down to, a 1 or 100%. And so this is the highest it's ever been.
Mhm.
Highest the Buffett indicator, never been here before. And here we are. Okay. So again, price for perfection. And then this one's kind of interesting. This comes from Bloomberg. This combines almost all of them: the trailing PE, the Buffett indicator, the Q ratio, put price to book, all of those. And you can see we actually just became higher than the Great Depression in 1929, based on all of those measures mixed together. So, nonetheless, this is a market that's very expensive. So always be a little cautious in these types of markets. Again, we could go up 40 to 50% from here. I wouldn't even
Mhm.
be surprised. We did that in 2000 in a lot of ways. Everybody was talking about how expensive it was, how narrow it was, all these different, it just kept going anyway. But again, in 2000, we didn't have tariffs. We didn't have deportations. We didn't have a Federal Reserve's independence being challenged. Right. So those are big. All right. So this is a little hard to see, but this comes from Yahoo Finance. And I guess one of my points here is that if we are going to start to question the numbers coming out of the government, like we're going to get another jobs report. Okay,
Mhm.
the last jobs report came out, they fired the person kind of in charge of all of these reports, the Bureau BLS, whatever that stands for. And so we're going to get a jobs report. Can we trust it or not? I don't know. Actually, matter of fact, I'll have a high level of skepticism over all these reports going forward. What I really want to focus on is earnings. right? Because the regulations for earnings haven't changed, the reporting hasn't changed, shareholder lawsuits are sitting out there. These companies have a really hard time lying on their earnings. That has happened. Just look up Enron, right? But it's not very common. And so these are earnings reports, and basically what were the hits to corporate profits. So listening to the earnings reports. So Apple says 800 million dollar hit in the second quarter to its earnings from the tariffs. Caterpillar says 1.3 to 1.5 billion in fiscal 2025,
Mhm.
right? Ford 2 billion, GE Aerospace 500 million, GM General Motors 1.1 billion, Hershey 170 180 million, Hyundai 594 million, Procter and Gamble 1 billion, Stellantis 1.3 billion, Tesla 300 million for the quarter. Okay, not for the year. The other ones were for the quarter. First one for the quarter, middle ones are all for the fiscal year, and the last one was for a quarter also. So think about that. So that's money that is just disappearing. This isn't going to corporate profits, which would increase the share price. This isn't going to new hiring. It's not going into new research, new projects, new capital expenditure. This is simply a tax that's going straight to the US government. And it still hasn't been described what they're doing with that money, but that's another story. And so this is the problem with this is drain that is there that wasn't there before. Now, the one thing that's interesting here, corporate tax went from 35% down to 21%, right? And so this is a way to kind of bring it back up from 21. We were doing okay. Matter of fact, in 2095 to 2000 run, the corporate tax was 35%.
Mhm.
But the problem is the pricing at this level is based on really the 21% corporate tax rate and not, this with the tariffs on there. And so here we are, we're at a point where the pricing is super high and we're not even counting, most of these measures of valuation are backward looking. And so we haven't really seen the impacts of what this is going to do to earnings. I think more and more you'll see these companies pass these along to the consumer, but that'll affect them also because now their prices are higher. When you raise price, the amount of demand drops at
Yeah,
those prices.
demand
Yeah,
destruction.
yeah. So if Ford has to raise the cost of their cars, they're going to sell less cars. And so that's going to hit them on the revenue side. It might be less impact than having a $2 billion cost directly to pay tariffs. If they put that $2 billion cost to the consumer, maybe they lose $1 billion because of reduced sales or something along those lines. So, but I think that is why we're going to see the movement to consumers, even though there will be an impact. If you look at it from an economic standpoint, and I bet the impact is less than actually paying the tariffs directly out of your own bottom line. Okay. And so that's kind of the issue. Now we can really start to talk about things for real, not just looking at, what might be happening. It is starting to happen. These are all earnings reports that have come out here in the second quarter. Be fascinating to see how this progresses and keep watching these reports and whatnot and listening to the future projections from these companies. None of this has affected the stock market. Okay. So one of the things that is very interesting about the stock market, it does a really good job of making the nuanced moves, but it can sometimes miss the monstrous changes. So for example, in 2008, the market was still going up, even though mortgage delinquencies were really skyrocketing. I mean, people were finding trouble paying their mortgage, mainly because they gave them a mortgage they could never afford in the
Mhm.
first place, right? They were giving them to everybody. And, the market hadn't really responded to that. That started in 2005. And 2007 was the peak, October of 2007, went for a really long time. And then finally it started to become more obvious to start talking about subprime mortgages, but the market still didn't really understand the full impact of that and really the impact of these credit default swaps, which were these insurance policies on top of those mortgages that these companies had to pay off when these mortgages went bust. And we ended up with a 57% stock market return. And so it's one of these things where it's like boiling a frog, right? I mean, you put a frog in some water and you turn up the heat really slow, and the frog doesn't really realize he needs to jump out of that water until maybe it's too late. And that's kind of what's happening here. We've got this scenario where anybody who really understands how the economy works, how earnings work, how much importance they have, is seeing this destruction of some of those areas and some of those pillars that were holding this market up and we're already expensive. If we were
Yeah.
cheap, that might be different, right? Maybe we don't fall as much. We are very likely the most expensive stock market in history. So, and then we've got these things happening. Why would we continue to go up, right? I don't think the market is kind of missing out. And so either those things will disappear. We'll figure out a better way to do deportation so we can still support agriculture, construction, meat packing, all those types of things. And that's possible. They can do that, right? They can come up with programs to bring people in on a limited basis to do those things. They've done that in the past.
Mhm.
The tariffs could disappear. Unfortunately, the tariffs are going up. We're up to 19 and a half now. According to the Yale Budget Lab, we were at 18.6, but it keeps throwing up new tariffs, new line item tariffs, new threats. I mean, the threat to China right now is because they're slow walking the magnets to us through this rare earth metal, monopoly that they have. And then we're threatening a 200% tariff, which of course would be bad for us too. So it's kind of interesting how that works. But so that's the challenge that, you're gonna deal with, in this particular environment, and then the last thing is really the independence of the Fed, because, look, this is a pretty interesting breakdown. The red line here shows what happened to, inflation in '67 to '83, and we kinda had these 3 waves of inflation. And you have to understand this if you want to understand what the Fed is thinking. So, we're looking at this and saying, okay, inflation is going up even as we speak. We just talked about that a little, at least. And unemployment and the job market is getting weaker, as we've seen from these reports. And so, what do? If they lower rates, they might create that third wave
Mhm.
of upward. And so they know this. Okay. This Federal Reserve, matter of fact, Chairman Powell has talked about this multiple times. He does not want to be involved with the Federal Reserve that creates that third wave, because that was very, destructive. The Fed fund rates right now is around four and a quarter, four and a half, and it got to 19% at the
Yeah,
top of
they
that.
essentially have to break the market
Yeah,
to fix inflation.
yeah. And so that's the fear that they have. I think the one difference here is most of our inflation might be caused by tariffs. Could be a one-time thing, could be a temporary thing, but actually we don't know that for sure. It could cascade into other pieces because now I'm paying more money at the grocery store. I go to my boss, I need to get some more money, and I might work in any business and all of a sudden that process and that product gets more expensive, or that company starts to make less money depending on what they do with those increased wages. So anyway, that's kind of where we're at the moment. Um, I think I still believe, okay, very strongly, even though the market has been coming up a lot. I believe that there's some underpinnings here that we have to be aware of and cautious with. And I think a one third, market out, and 2/3 in on our normal allocation makes complete sense to me. We're still more in than out. The market is still going up, right? We still have artificial intelligence, we still have deregulation, we still have this new tax cuts, we still have a lot of powerful pieces. We still have companies making good money. Earnings have been good as a whole across the board. Again, we weren't expecting earnings destruction yet, so that's still coming. But
Probably third quarter, fourth quarter as well.
I bet you fourth is much more so than third, but yeah, I think we'll start to see more. We've seen some in the second. We
Yeah,
just went over those, and we'll see some more, coming forward in those other quarters, in my opinion. But those are all reasons to be 2/3 in, right? Because if the other side, if the tariffs disappear or reduce, which they can do on a whim, right, at a moment's notice, if the deportations change, which could also change pretty rapidly, the Federal Reserve somehow gets its independence back, some form or fashion of that. These are all things that would then wipe out the negatives, and the positives would be there. And at that point in time, you definitely want to be 100% allocation in. But until that happens, I think a one third, 2/3, and that could change. We start to see the momentum of the market fall off and really start to come down. Maybe you want to have a little less exposure just because it could be the beginning of a problem. But September is, historically the worst month of the year, right? It's the 1928 to now, and it's the only month to have a negative rate of return on average, as far as that goes. However, we have the Federal Reserve lowering rates, most likely 86% chance, according to the market, that they're lowering rates on the 17th, or I think the meeting's on the 17th of September, and so uh, that could boost the market enough to make it for a decent month still. And the market has been operating on that rate cut aspect. It likes that quite a bit. So So anyway, that's where we're at right now. I think it's a very interesting time, to be paying attention to learning and to seeing, because we're seeing things that we've never seen before in our lifetimes. We haven't seen tariffs. We can go back and study what has happened historically. This level of deportation and the way that it's happening, we haven't seen that before. Nobody's ever tried to fire a Fed governor. No president has
Mm,
ever tried to fire a Fed governor. We're seeing things we've never seen. How does the market react? What does it really mean? Does it really matter, or is it just news? Right. So those are things we're going to learn as we go here. So anyway, look forward to being able to talk to you again next week. And obviously I'll do my daily videos during the week, and then we'll do the summary here on the show. So